A final fling for the ASX can't hide a very ordinary 2023. The last big weekend of auction sales ends with little joy, and Australia's two richest people, Gina Rinehart and Forrest, square off in the fashion world. Welcome to Fear and Greed Business News, Australia's best business podcast. It's Monday, the 18th of December, 2023. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. Last Monday for you and I for the year.
That's right. And the thing is, we will have new episodes every day over the Christmas period. It's just that we changed to a different format from the end of this week because the business news cycle just slows down just a little bit, and there's often not quite enough to fill a full 20-minute episode.
That is exactly right. In fact, next week, though, we go through yourself, Adam Lang, our colleague, and I, and we run through all sorts of things that has happened over the past year. Often it gets a little bit competitive. Well worth a listen next week, Michael.
Funny that. For anyone who's listened to the weekend edition of Fear and Greed, they will probably not be surprised at all to hear that next week's episodes will be slightly competitive. But yeah. Sean, after today's episode, you have an interview coming up. It's a really good one for investors. You're talking to Eduardo Repetto, who is the Chief Investment Officer at Avantis Investors.
He is, and we talk about exchange-traded funds from a global perspective. We've done plenty on ETFs from a local perspective. We talk about specific countries. We talk about technology plays, ESG plays, all that sort of thing. So if you're an investor, even if you're not interested in ETFs, I still think you should be listening to this one because it's a fascinating chat from a global perspective.
Speaking of investing, Sean, that's really the main story this morning. 2023 won't be a golden year for the local share market, notwithstanding a near 10% rise since late October, with the S&P ASX 200 in line to finish the year up about 5%.
But within the bourse, there have been some big winners and some big losers. It's been the year for tech stocks and some consumer discretionary companies, as well as real estate investment trusts. But not so much for the energy sector, which of course did have a great 2022, not such a good 2023. The common factor among the winners is they do better when interest rates aren't rising, preferably they're falling. Now, rates did rise this year, but it is the end of the rate rising cycle, and the share market tends to be 6 months ahead of the real economy or thereabouts. Therefore, probably not a surprise that the interest rate sensitive stocks did well. Best of the top 200 goes to some of the smaller resources and biotech stocks, Emerald Resources, Ramelius Resources, Codan and Neuron Pharmaceuticals. Of the large caps, the best has been US focused James Hardie Industries, which has benefited from operating in a sweet spot in the US construction industry. It's up around 75% over the past year. Not bad. Another building group, Boral, has been a strong performer, and that's dragged major shareholder Seven Group Holdings along for the ride. Among the tech stocks, Xero is a standout, up 45%, while NextDC, REA and WiseTech Global also have had good years. Healthcare group Cochlear, Super Retail Group, owner of Supercheap Auto, Rebel, BCF and Macpac, and iron ore giant Fortescue Metals, they are all very strong performers in the last year or so. Worst of the ASX 200 goes to, drumroll, the Star Entertainment Group, down close to 80% over the past year. No one else came close to that performance, though some of the green metals companies didn't do so well after a pretty good 2022. Nickel and copper group IGO, mineral sands company Iluka Resources, and lithium plays Mineral Resources and Allkem, none of them did particularly well, neither Alumina or Nickel Industries. Most of that's because the price of green commodities fell. Away from mining, there were big drops from the A2 Milk Company, which fell pretty much all year on the back of concerns about markets and manufacturing. Gaming group Tabcorp tumbled, particularly since September when it said trading conditions were soft. AMP was another underperformer, so too pubs and bottle shop owner Endeavour and diversified miner South32. Among the retailers, Harvey Norman's had a tough year, so too Lovisa Holdings. Domino's has had a shocker, down nearly 20%. Flip side of that, well, Super Retail Group I mentioned, JB Hi-Fi, Breville and Eagers Automotive.
Sean, what about the most popular stocks, the mum and dad stocks?
Probably the best two are Woolies and ANZ. Rio's been pretty good too, thanks to higher iron ore prices. I mentioned Fortescue Metals a moment ago. Wesfarmers and Goodman Group have done pretty well. Commonwealth Bank and ANZ, at least they're in the black over the last year, as is BHP. Same can't be said for National Australia Bank, Telstra, Coles or Westpac. Qantas ends a turbulent year, down around 10%. So too CSL, QBE and to a greater extent IAG have been able to pass through higher premiums. The insurers' share prices have done pretty well. Lots of people hold IAG in particular because it used to be the old NRMA, so many people hold stock in that one. They've done pretty well. All in all, though, I'd say a pretty ordinary year, 2023.
Might be an ordinary year, but that was an extraordinary wrap, Sean. I think you just did. I was trying to count them. I was listening while you were talking, but I was counting stocks as well. And I think you just mentioned like 45 or 46 companies in the first few minutes of today's show.
That's a good show if you can do that.
I reckon that's not too bad at all. How did local markets finish up on Friday?
The S&P ASX 200 jumped nearly 1% to finish at 7,443 points. That's another 5-month high. For the week, the bourse was up 3.4%. Friday's surge came on the back of a big rally on Wall Street on Thursday night, Friday morning, Australian time. That's all about interest rates in the US.
Yeah, what is happening in international markets?
Yeah, well, interest rates in the US, that's what it's all about. Or more accurately, when will interest rates start falling? That seems to be the guessing game now. The news on that was a little mixed in recent days, with US retail sales jumping in November. Still, the Dow Jones Industrial Average hit a new record high, and the broad-based S&P 500 is close to a record high. The greenback fell further over the weekend to a 4-month low, pushing the Aussie dollar up to above 67 US cents. Brent crude prices jumped quite a bit over the weekend, and gold is trading around 2,035 US dollars an ounce, Michael.
All right, big start to the show. We'll be back in a moment with the rest of the day's business news. Sean, auction clearance rates took a bit of a tumble over the weekend, particularly in Sydney, where the preliminary clearance rate fell to its lowest level this year.
Yes, ending the year with a whimper. Sydney's clearance rate fell 1 percentage point to 65.5%, according to CoreLogic, undoubtedly reflecting the rate rises, including the November hike. Sydney's weaker results coincided with further deterioration in home values in that city, based on CoreLogic's daily index. Over the last 4 weeks, Sydney values flattened out, and in fact, they're kind of on track to end December lower. That's according to CoreLogic. It's possible Sydney home prices end the year lower. There were more than 1,400 homes taken to auction across Melbourne over the weekend, with a preliminary clearance rate of 66.9%, marginally better than last week's rate. In other capital cities, Adelaide posted an 81.7% preliminary clearance rate, Brisbane was at 56.3%, and Canberra just about 66%.
Now, this is an interesting one, Sean. The competition watchdog has criticised the banks for complex retail deposit pricing, recommending new regulations that require customers to be notified of rate changes and allow customers to better compare returns on competing deposit products.
The Australian Competition and Consumer Commission says it sees enormous potential from bank account portability to increase customer switching. It would operate a bit like porting your phone number from one carrier to another, and it would just be much easier for customers to switch deposit accounts between banks. In its Retail Deposits Inquiry final report, released on Friday, the ACCC said banks' pricing for many retail deposits, including introductory or bonus interest rates, made comparing rates difficult. In the first half of 2023, it found 71% of bonus interest accounts, which have total balances of about $300 billion, didn't actually receive the bonus amount on average each month. The regulator wants base rates to which bonus offers reset to be more clearly displayed in marketing. It wants banks to actively prompt customers to get them to consider switching to an account offering a higher rate. And the ACCC criticised comparison websites for not disclosing clearly any commissions they might be receiving from the banks for promoting interest rates. So we've heard lots about the mortgage market, but now the watchdog is looking at the deposit market, and given more people are putting money into deposits because interest rates are much higher, I think it's good timing.
And this idea of being able to easily kind of shift your money and your accounts around, is that all kind of tied in with the open banking shift?
Yeah, it's totally open bank. It's taken longer, like they were called read-only accounts for a while. That's moved further. It should theoretically be quite easy to shift between home loans and deposits and things like that. It's getting there, but it is still a little bit cumbersome.
Yeah. Now, Sean, you mentioned the ACCC quite a bit there. The ACCC has been somewhat busy, I would say. On Friday, it blocked plans for the numbers 2 and 3 pathology players to join, not allowing Australian clinical labs buyout of Healius.
ACL is the smaller of the two and came up with the plan. But a few things have happened since March when the deal was announced beyond the Australian Competition and Consumer Commission's rejection. The big one is the deterioration in Helios's share price, down 45% since the offer. That was in response to Helios's board initially rejecting the ACL offer. Shareholders liked the deal, the board didn't. Eventually, its chairwoman was forced out by angry investors. ACL said it remains open to a future deal provided the terms are recut, and will be closely monitoring the performance of Helios over the next few months. But as it stands today, the numbers 2 and 3 pathology players won't be joining.
Sean, Gina Rinehart and Andrew Forrest are squaring up in the apparel market with the country's richest person buying Rossi boots.
Don't you love this story? Did you know that those two, they're mining billionaires, they actually grew up a few hundred kilometres apart on cattle stations in Western Australia?
Really?
Quite remarkable.
I didn't know that.
Yeah. And their competition very much goes beyond iron ore, and they've always slightly been competitive. Well, I think both of them are competitive individuals anyway. Gina Rinehart's Rossi acquisition creates the potential for her, who's also acquired Dreiser Bone, to branch out into producing Kidman branded apparel, Kidman being her company. So producing Kidman branded apparel to compete with the Forrest-owned RM Williams. The Forrest family acquired the iconic boot and clothing maker for about $190 million in October 2020. It's just added hat maker Akruba to the stable. So it looks like it's on in the fashion stakes between Andrew Forrest and Gina Rinehart.
Yeah, it seems like there's a fair amount of kind of patriotism involved in this as well, isn't it? Because these are all iconic Australian names that they are buying up. And it's great to see them remaining in Australia.
Yeah, that's true. It is better that they're in Australia than otherwise, but a bit of showmanship sometimes, I think.
Yeah, I suspect you might be right. I just love the idea of them kind of growing up only a couple of 100 kilometres apart on cattle stations. I suppose in relative terms, in that kind of area, they'd probably be each other's closest neighbours almost.
Maybe, yeah.
Now, the federal government needs to review Australia's steel-making capabilities to ensure there's enough metal to keep building rail networks, wind farms and telecommunications towers. This is a warning from the Commonwealth's Infrastructure Advisory Body.
Steel imports into Australia are 20% higher in fiscal 2021 and fiscal 2022 compared with average imports over the previous 2 decades, according to Infrastructure Australia's 2023 Market Capacity Report. But the jump has sparked concerns that infrastructure projects could become dependent on imported steel rather than local steel. That makes them vulnerable to future glitches in global supply chains. We know all about that because of COVID. It also makes them more costly, potentially anyway, according to a report in the Financial Review. Infrastructure Australia's Chief Executive, Adam Kopp, said the government needs to figure out what's going on with the steel market and ensure the nation has enough quarries and factories to produce essential construction materials like cement. It also said Australia has a shortage of 29,000 full-time infrastructure workers, particularly engineers and scientists, at a time when productivity in the construction sector remains stagnant. So a very stark warning there from the advisory body.
Okay, Sean, turning to international news now. And Donald Trump, the US Republican presidential frontrunner, says that undocumented immigrants are poisoning the blood of our country, repeating language that has previously drawn criticism as xenophobic and echoing of Nazi rhetoric.
Trump made the comments during a campaign event in New Hampshire over the weekend where he railed against migrant crossings at the US-Mexico border, which hit new highs in September. He's promised to crack down on illegal immigration and restrict legal immigration if elected to a second 4-year term in office. And I quote, "They're poisoning the blood of our country," he told a rally, adding that immigrants were coming to the US from Asia and Africa, in addition to South America. Maybe Europeans are okay. Don't know. I'm not sure about Australasians. We'll see. Anyway, according to a report on Reuters, Trump has made border security a major theme of his campaign. He's vowing to restore the hardline policies from his presidency from 2017 to 2021 and implement new ones that clamp down further on immigration. US President Joe Biden, who is the presumptive Democratic Party nominee, has sought to enact more humane and orderly immigration policies. He's really struggled, though, with record levels of migrants, a problem seen as a vulnerability for his re-election campaign.
Now, last one, Sean, how about this? This is staggering. The House of Nyan from Abu Dhabi has just joined the Bloomberg list of richest dynasties and come in at just at number one, right in at the top of the list, worth $305 billion US.
Move over the Waltons of Walmart fame. The Al-Nyans are number one. They made their money from, one guess, oil. No surprising, I suppose. They're from Abu Dhabi. In fact, petrol fortunes are reshaping global business and family wealth like never before, according to Bloomberg. Of course, prices are sky high at the moment. The Al Thanis dynasty, the royal family of Qatar, are also new to the list. They come in at number 5. In fact, the world's richest families have gotten $1.5 trillion US dollars with a T, trillion US dollars, wealthier since the last ranking. Another fast mover was the dynasty behind luxury brand Hermes. They added $56 billion. They're now the third richest family behind the Al-Nyans and Waltons. Coming in at number 4 are any guess, Michael?
I honestly don't know. This list, the only ones that I would have been expecting to be on there was the Waltons.
That was the third.
And so I'm just like, this is kind of blowing me away.
So the number 4 is the Mars family, as in the candy bar.
As in Mars bars?
Yeah.
What?
So Frank Mars began selling candy bars back in 1902. It's now, I think it's more than 50% revenue is pet food as well as chocolate. They're the 4th richest family in the world. Pretty cool.
That's amazing. That's a great story to finish on, Sean.
It is.
Well done. Now, up next is the Fear and Greed Daily Interview. This is a good interview too. Eduardo Repetto from Avantis Investors.
Yes, all about exchange-traded funds, but from a global perspective. Eduardo is speaking to us from South Korea, and he travels the world looking at global ETFs, and he tells us what he thinks of them.
Yeah, it's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And after you've listened to that one, I'd have a listen to Fear and Greed the week ahead, our last one for the year, featuring our resident economist, Stephen Koukoulas.
Not a lot going on this week, we've got to say, but Stephen has plenty to say about the year behind. And we have a good chat about what's gone on. The Reserve Bank minutes are out tomorrow, so we do have a bit of a chat about that. But as always, very enjoyable chat with Stephen.
Yeah, it's a very good one. Thank you, Sean.
Thank you, Michael.
It's Monday, the 18th of December, 2023. Make sure you're following the podcast and please join us online as well on LinkedIn, Instagram, X and Facebook. I'm Michael Thompson and that's Fear and Greed Business News. Have a great day.